Financial Cycles Summit. We are almost through, and but I'm having as much fun as ever. I mean, this has been an incredible week. I can't believe all of the insights and talent and experience that we've been able to bring to this week. So I've learned so much, and I'm looking forward to today with my first guests, Ray Tomes from the Cycles Research Institute. Welcome, Ray.
Thank you, Richard.
And David Hickson from Sentient Trader. Welcome, David.
Thank you. Thank you very much, Richard.
So folks, just a little bit of background. I don't want to take up too much time because we want to get right into it. Ray and David have some very great information for us, and a lot of information as usual. We're trying to pack it into an hour. I keep saying over and over again, don't worry about it. These are being recorded. We will unpack them in the months to come. So we are drinking from the fire hose this week, and that's the way it's intended to be. So don't try to just, don't worry that you're missing something. This is just the beginning. So Ray, you have been running the Cycles Research Institute. How long have you been running that? At least a decade, maybe two?
Yeah, it's getting close to 2 decades now.
Getting close to 2 decades. And, as far as I'm concerned, you've been carrying the torch really of the cycles community and of Edward Dewey. You've really, as much as anyone I know, you study cycles in the broadest sense, not just financial cycles, but true scientific cycles. You're connected with people across the cycles community. So it's just very wonderful to be working with you again, and to have the foundation and CRI working together going forward. And David, I think you've known Ray for a decade or two?
Yeah, I was thinking about it. It's been 11 years now, I think.
Yep. Fantastic.
Yes. And I'd started building my software, and Ray was extremely helpful in terms of pointing me in the right direction.
And like a lot of people in the cycles world, you have a creative background, I would say. You're involved in filmmaking and directing and background in architecture.
Yes, that's right. I did an architectural degree and then started a career in filmmaking. So I'm a film director and writer. And there was something about financial markets that was really fascinating. And I guess as a creative person, cycles really appeal to the sort of visual aspect of the way that I tend to approach financial markets.
An architectural background sounds perfect for an interest in cycles.
Yes, exactly.
Studying the architecture of the universe, right?
Yeah, and a fascination with the way that things work together and how the mathematics of things relate to each other. Right. And actually the visual aspect. I think that cycles are a particularly visual approach. They're mathematical, but also visual, seeing patterns and so forth.
Wonderful. Ray, I don't think I ever asked you how you got interested in cycles.
I think I first got interested when I was a teenager, and I got a magazine called Sky and Telescope, and it had daily sunspot numbers, and I started plotting them. And I found, hey, there's a 4-month cycle, and that one's going to come up today, incidentally. So it was a bit later when I started working in computers. I ended up with a financial institution in their investments department, and then of course I got very interested in it. Then I came across Hearst book at that stage. Right. Didn't quite click about it all then, and then later on I started analyzing things, and I found there were these cycles and that they were harmonically related. And that stage I heard about the foundation that was from George Lane, is it? He gave a seminar in New Zealand in the late 80s, and at that stage I found out about the foundation and started going along to the foundation.
And you are in New Zealand, right?
That's right, yep.
And David, you're in Italy.
I'm in Italy, yeah, so it's the evening here.
And Ray, we're going to work together to put on a scientific cycles summit later this year.
Yes, for sure.
Fantastic.
I'm looking forward to that.
Really forward to that. All right, well, gentlemen, let's get into it. I know we've got a lot to cover. And so we can turn off our cameras, and Ray, I guess you're going to start going over kind of different cycles and harmonic cycles, and then passing the torch to David to talk more about kind of how this is also seen in Hurst cycles and seeing David's software.
Yep.
Fantastic. So do you need any help sharing your screen, or you got it?
I'll give it a try. How are we doing?
Perfect. All right, let's turn off our cameras so we don't distract from the slides. And
you might have to turn mine off.
Okay, I can do that. Let's see. There we go.
Okay, so I'm Ray Tobes. I live in New Zealand. That's why I have this funny accent. That's my personal website up the top there. And as Richard mentioned, I started Cycles Research Institute I think it was about 2001. And that's the web address for that. I should mention that Cycles Research Institute and the Foundation for Study of Cycles are working closely together now, and there's the intention to get us all into one thing. Perhaps we'll just have a sort of specialization in science in this part and Argus in the other, or something, I don't know. We'll work that out. Today I want to talk about harmonically related cycles in the IBM share price. Now, it doesn't have to be IBM. It's the same for any different stocks. There's a long history on this. People will know that Gann has talked about cycles that are harmonically related, that Hurst has, and that Dewey did. All three did work in markets, financial ones. Dewey also did work in other fields, scientific and others, and so he found the pattern in all these things. Dewey cycles came on down, and one of them he had was 0.33 of a year, and 0.66 of a year, and other longer ones harmonically related. 0.33 of a year is 120 days, and you'll see that's part of the pattern we've got here. Gann mentioned that. Hurst, I think, mentions that. One other person I will mention is Kotov. Now, he's a Russian astronomer. He comes from a different background, but he designed a method of finding, he called it communality index. I call it Kotov's method in honor of him because he did a lot of work with that. In particular, he did a lot of work about a 160-minute cycle and some related ones. And he found many cycles that were multiples or fractions of that. So he made this index that looked for multiples and fractions of something in a lot of different data. This is a graph of the IBM share price on a log scale since the early 60s through to the early 2010s when I did this. And you can see it's got lots of ups and downs. It's got some long cycles, some medium cycles, and some short cycles. I used our CAT software, which is available for free on the Cycles Research Institute website. At some stage, we'll hope Lars is going to hopefully help me to get that up available on the cloud, that people can use it for free from their phones. At the moment, you have to install it on Windows. So when this was run through CATS, it identified a lot of cycles. It found 67 different periods that were significant. And I've listed them in order of the strongest ones. So it found a 13-day, nearly 21 days, 39 days, and so on. If we're looking at this, it's a lot of stuff. And if we try to just do a forecast based on all those cycles, it doesn't work particularly well. So what we're interested in, is there a bit of a deeper pattern to this? And for example, if we look at the third figure, it's just a little under 40 days. We'll see the first figure is a third that much. The second figure, a little more than half. And the last one on the top line, nearly 10 days, is a quarter. And we'll see other ones that are fractions. So what Kotov's method is doing is it takes all of these and we go through, I started at 1 day and I went through to about 150 days. And for every value there that's been plotted, it's taking that value and it's comparing it to all of those different cycles, and it's dividing the smaller one into the larger one, and it's seeing how near to an integer it is. If it's near to an integer, that's good. That's what we're looking for. And it adds up all the errors, how much it misses the integers by. and then it plots this on a graph. And it inverts it, because when there's a minimum number of errors, there's a lot of cycles. So, for example, the 10-day one there, we can see there's a big peak. Around 10 days, there's a lot of cycles in those ones that were found. In those 67 cycles, there's a lot of them that are very close to exact multiples or exact fractions of 10 days. And so
Ray,
we can...
Are
Yep.
we looking at, this isn't the price of IBM here. This is sort of
No,
the
this is
distribution of cycles in
yes,
the data.
that's right. This is a spectrum derived by Kotov's
Right.
method. It's called a communality index, and it's only showing us the periods that tend to be multiples or fractions of all those cycles that were found.
Right.
So we can see there's we can see this
peak.
Yeah,
There's a big peak there, which means that's one of the strongest cycles.
Yeah, one of the strongest, and the other ones, it's not just a strong cycle. There's other ones that are multiples or fractions of that.
It's amazing, because you look at, I mean, it's so obvious in this data.
It's very clear, the 2.5, 5, 10, 20, 60, 120. So we see this many ratios of 2 and the odd ratio of 3. This is a very common thing found in cycles and everything, this pattern of things.
So you're not, is this in your CATS software or no?
No, this isn't in the CATS. There's a program I've called Qua CSV, which you can feed a set of values in, and it will do this analysis. Unfortunately, that one, I'm quite happy to share that, but it's written in it uses a graphics program. It only works in conjunction with that. So if someone wants to take it and make it work generally, it would be possible to do that. It's not very complicated maths. Yeah. So we see that pattern there, and I believe, like Dewey mentions a 0.33 year cycle, that's the 120 days. That was at the lower end of the ones he was doing, but Gann mentions these periods, and I think Hurst mentions those periods as well, and they do show up a lot. In some things you get a different series. In for example, the electromagnetic field of the Earth, you get 3.5, 7, 14, 28. There's a different series in between those. So now let's just look at how one of these, I'm going to look at that 120-day peak. The actual best peak it found was at 119.04 days. And what I'm showing here is from those 67 different cycles periods that I fed into this, it's taking a look at how it does the analysis. So the 39-day one is that figure divided by 3.0328, etc. And we can see that's very close to 3. It misses by just 0.032. The 9.96 is that one divided by 11.9, it misses by 0.05. So these are the top, the ones that missed by less than 0.1. Now there's randomly you're going to get a lot of hits on things like that, but there's twice as many of those figures that match within 0.1 as there ought to be.
So there are 3, repetitions of the 39-day cycle and the 119-day cycle.
That's right. Yeah.
12 repetitions.
12 of the 10-day one.
Cycle and the 100.
And so on.
Cycle.
Yeah. And in another case, in the 486-day one, it's the other way around. There's 4 repetitions of the 120 and the 480, right?
Okay.
So this gives you some idea. You can then you can do this for each of those cycles, but that just gives you the idea of what its method is.
Tell you that 119 or 120-day cycle is a special cycle amongst all these cycles?
It's well, of the 5 peaks I had there, it was a medium of those. So the 40-day one would probably the 20-day one. The 10-day which was the biggest peak, 10-day, I think. The 10-day was the biggest one. So the 120 was sort of average of those.
Right.
Now, so that's the gist of it. You can get to that directly with just a cycles analysis, but not quite as clearly. This is the IBM share price, log of IBM share price, spectrum, and then again the log of the spectrum, because it drops off so quickly over this whole range. And you can see in that there are a little bunch of cycles around 20 days there. The red figures are significant cycles in days. So you can see there's a bunch of them around the range 19 to 21 days.
Can you just show with your cursor where you're talking about?
Can you see my cursor?
Yeah.
Okay. So those 20, so there's quite a bunch of cycles found around 20 days, another one near 40 days, another little bunch at 10 days, which is a half of that. The 13 days is a third of the 39. And
So
then
this
another
is a different method of detecting cycles, but it's showing the same thing as
so this is a normal cycles analysis. This was done with cats. It's just a normal cycles analysis. And you can see a couple more around 6.7, which is a third of the 20-day, a couple more around 7 days, which is the week. And the others don't all fit that, but that gives you the same idea. So that's it really. It's recognizing that there is this pattern of cycles, often ratios of 2 and 3 like that. Sometimes there's other ratios in them. When David, who's going to talk next, was doing his original program, he was following Hurst's method exactly, which had ratios of 2 and 3. And I said to him, but this one down here, you really need a ratio of 5. And he said, after a little while, he said, yes, you're right, but I've got to do this Hurst program first. And after that, I'm going to do another one. And he called it Sentient Trader, and he incorporated that in it as well. So his in the CAT software, you can do a lot of good analysis, but it's not a forecasting tool. There's other people have done that. And David's program is one for trying to, forecasting is another thing, trading is another thing, but he's gone into how do you do trading with this. So it's taking this sort of knowledge, which he got from Hurst, and he got a little bit more from me, I think. And from that, he's made a trading tool that can use that knowledge. Okay, I think that's it for me, really. Yeah.
Okay. So.
Fantastic. Should I start sharing my screen?
Yes, David, please share your screen. Ray, I really want to learn more about that program and that methodology and see what we can do there to make it more available.
Sure. Yep.
Fantastic. Thanks. All right, David, take it
away.
Okay.
Thank you. Thank you very much, Ray. So I'm going to speak about what Ray has introduced us to and extend it and discuss what Hurst had to say about cycles. And what I would like to do initially is clear up some of the confusion that happens around the name Hurst and when we speak about Hurst cycles. And that is because Hurst actually wrote 2 very important works. The first thing that he wrote was a book called The Profit Magic of Stock Transaction Timing. And I described the approach that he presented in that book as being a mathematical approach. And he did a lot of spectral analysis of data, and he highlighted the existence of cycles, very much as Ray has done in his presentation. And he discussed the identification of these cycles. He drew up a list of those cycles. And then a few years later, he released a second very important piece of work called the J.M. Hurst Cyclitech Cycles course. Now, Cyclitech was the name of his company. So it was a very big workshop style course. It's over 1,000 pages long. And it took the ideas that he presented in the original book and it developed them and actually presented them in a very different way. And I refer to the way in which he presented those ideas as a matter of pattern recognition, because he had moved away from using purely spectral analysis to identify the cycles, although that's still a very important part of what he always did. But he would then take that information and he would apply a pattern recognition approach. So he would look at the charts. And one of the reasons why the cycles course was so many pages is because it took him a very long time to explain exactly how one should go about the analysis process. So that is why when people speak about Hurst cycles, I often find myself saying, are you speaking about the mathematical approach that he spoke about in the Profit Magic book, or the pattern recognition approach that he spoke about in the cycles course? So those 2 pieces of work really are the full body of Hurst cycles. And we've seen some fascinating presentations already this week from Peter Eliades, who spoke about Hurst cycles. And his approach is probably mostly informed by the mathematical side of what Hurst was doing. And the 2 aspects of Hurst's work really fit together very tightly. I thought it'd be interesting to speak about what makes Hurst cycles different to other cycles. We've spent an entire week watching some great presentations about different cycles and how they influence stock markets and financial markets generally. So what is it that makes Hurst's cycles different from any other cycles? So there are a few things that I've highlighted here. The first thing is that Hurst specified very clearly that the cycles he was looking at exist in continuous time, which means that they play out 24 hours a day, 7 days a week, 365 and a quarter days a year. And that was a really important aspect of his approach. Nowadays, people are often asking, do these cycles refer to trading days, you know, Monday to Friday with a few holidays every now and then, or do they refer to calendar days? And when it comes to Hurst's original work, he was always speaking about calendar days because of the fact that he believed the cycles existed in real time, and that if we happened to be lying on the beach and not trading, the cycles were nevertheless moving, which is an interesting idea.
That is really, that's a great point, David. Thanks for bringing that up.
Yeah, and it was interesting to see in Peter's presentation that he discussed that, and he had developed software that could take Hurst cycles from calendar days and apply it to a chart that displayed only trading days. Mm-hmm. So it's constantly an important aspect of Hurst cycles. The next thing that's really important and that differentiates Hurst cycles from many other cycle approaches is that Hurst stated that there are multiple cycles always influencing the markets. Ray has just shown us a whole list. There were, what were the 67 cycles that you discovered in there? So the fact that there are multiple cycles is very important. And what is particularly important is how those cycles combine and work together to produce the resulting price action. And one of the ways in which the multiple cycles combine or work together is the fact that they are harmonic. And Hurst defined something called a nominal model that Peter spoke about on Tuesday as well, which is effectively simply a list of cycles. But the important thing about his nominal model is that the wavelengths between the cycles are all related by simple harmonic ratios. As Ray mentioned, Hurst originally specified that they are all related by either 2 or 3 to 1. Ray has pointed out that there are, in fact, probably some other ratios, such as the 5 to 1 ratio and 7 to 1 ratio. So this here is Hurst's nominal model that he published in the Cycles course. It differs slightly from the nominal model that he published earlier in the Profit Magic book. But this is the model. And as I mentioned, it's simply a list of cycles. So our left-hand column, we have the name of the cycle, which is why it's called a nominal model. It's simply referring to the name of the cycle. And then the central column is the average wavelength in days. And the right-hand column is the average wavelength in days, weeks, months, years, or in the shorter end of the scale, hours, all the way down to minutes. So there's a sort of a blue frame around the top part of this model from 5 days up to 18 years. Those are the cycles that Hurst had found in the markets. And it's important to note that he did a lot of research on the US stock market. That was his data that he worked with. And these are the cycles that he found in the US stock market. So potentially there are different cycles that work in currencies and in commodities. And that's probably a discussion for another day, but these are the cycles that he found. And so you can see the cycles of 17 days. He called the 20-day cycle, and the 34.1 day cycle, he called the 40-day cycle, because we don't really want to go around saying 34.1 days when it's a lot easier just to say the 40-day cycle. Shorter than the 5-day cycle, these are cycles that I have identified in the intraday spectrum. I say that I've identified it. In fact, I had a huge amount of help from early users of Sentient Trader software who were very experienced Hurst cycles analysts. And Ray can claim responsibility for the 160-minute cycle. I believe that's a sunspot cycle that Ray pointed out is very active in many financial markets. The 160-minute cycle is a really fantastic cycle.
That was the one that Kotov did a lot of work on, the 160-minute cycle in the sun, and he found it exists in binary stars, it exists in the cores of galaxies, it exists all over the universe.
And it's extraordinary to see it exists in the financial markets as well. So that is our harmonic nominal model, simply the list of cycles. But each one of those cycles has an average wavelength. The next really important thing that differentiates Hurst cycles from any other cycles approach, I believe, is the fact that he stated one of his principles is called the principle of variation. And he stated that although we have identified an average length of these cycles, the wavelengths, and in particular the amplitudes, are constantly subject to variation. So the wavelengths are constantly getting longer and shorter, and the amplitudes are getting greater and smaller. And so, for instance, the 40-day cycle, which we've just seen, has a length of 34 days. You might watch a market for a year or two and not find a single 34-day length cycle, because the cycles are averaging out at that length. But you might have a 45-day cycle, and then you've got a 28-day cycle, and then you have maybe a 50-day cycle, and then a 26-day cycle. But the average length is going to be 34 days. The next really important thing that differentiates, the next and last really important thing that differentiates Hurst's approach from other cycle approaches is that he stated in the cycles course, and it's really important to notice this, because in the Profit Magic book, he didn't speak about this, but in the cycles course, he stated that the troughs of the cycles are synchronized. And because the troughs of the cycles are synchronized, that means that the peaks are not. Now, I have Ray to thank for another insight here, which is that there are some markets that clearly exhibit the characteristics of being influenced by cycles that are synchronized at their peaks. In particular, precious metals such as gold and commodities clearly have cycles that are synchronized at their peaks, but stock markets have cycles that are synchronized at their troughs. And so I'm just going to quickly explain what the significance of that is. Here, obviously, is a sine wave demonstrating a sample cycle, and we're measuring the wavelength from in between two troughs or peaks or any two points on the cycles that have the same phase. When we combine these cycles and they are obeying the principle that their troughs are synchronized, as you can see here, then the resultant shape that forms on this, and let me see if I can create a pen here. The resultant shape that forms here is an M shape. And that is a direct result of the fact that the troughs are synchronized and the peaks are not. So here is a trough of the blue cycle, here is a trough of the blue and the pink cycle, and here's another trough of the blue and the pink cycle. So the result of having synchronized troughs is that we get these M shapes in the market. Another result is that where the peak in the cycle forms is not where the peak in price forms. You'll notice that it's called time translation, and it is a direct result of the fact that the cycles are synchronized at their troughs and not at their peaks. So the result is that we get very sharp troughs in the market, but we get very rounded and clustered peaks, and very difficult to forecast peaks. Here's another example, which is combining three cycles, a pink, a yellow, and a blue cycle. And I don't need to dwell on it, I don't think. You can see the troughs are synchronized where possible. They can't always be synchronized, of course, but where possible, they are synchronized. And the result is that you get these M shapes that form in the market. Oh, that's not a very, very good M shape, but you get those M shapes that form in the market. And that is a very important aspect that differentiates Hurst's approach as presented in the cycles course, and it differentiates it from other cycle approaches. So, having discussed the differences between Hurst and other approaches, I'd like to spend a moment speaking about the way in which Hurst recommended one perform an analysis, because there are in fact two separate stages to performing a full Hurst cycles analysis. The first stage is what I describe as a mathematical stage, because the work that he presented in the Profit Magic book is fundamental to everything he did. And the first thing he recommends that you do is that you identify the cycles that are currently active in the market, and you use a form of spectral analysis. And the form of spectral analysis that he presented in his cycles course and in the Profit Magic book, I believe, was actually a very simple form of spectral analysis. It wasn't nearly as complicated as the kind of analysis that Ray was showing us a moment ago, but it has very similar characteristics. And this is a result of performing that spectral analysis on the share price of IBM, all the way up until, I think I have data going up until yesterday. And so the high points or the peaks in this graph or chart, which Hurst referred to as a periodogram, highlight the most important cycles that have been found in the data. Very, very similar to the approach that Ray was speaking about a moment ago. So these are the really important cycles that have been found in this data. So you can see Ray was speaking about the 120 minutes. Let me use this pen instead of that mouse. And there is a very important cycle, just a few days shorter than 120 days. And so that's the result of the mathematical stage of the analysis. We perform a spectral analysis using the daily data, also the weekly data, and the monthly data. So it's worth pointing out here that the results of the monthly data are showing us something particularly interesting, which is that the most clearly prominent cycle in the monthly data is sitting here at about 72 months, which I think I'm correct in saying is 6 years. So 6 years isn't actually a cycle that Hurst identified. He identified a 54-month cycle. So we would expect to see a big spike here, but in fact we don't. And he also identified an 18-month cycle, and he identified a 9-year cycle. So we would expect to see them over here. So what's happening here is that the results of this spectral analysis indicate that the cycles that have been active in the data that we analyzed are possibly not currently running at the same wavelength that Hurst identified. But because we are working with a nominal model, as a cycle model that implies the harmonic relationship between these cycles, we can adjust the length of the cycles that we're looking for in the analysis. At which point we move on to the second stage of the analysis. I refer to it as the art stage, because Hurst famously said at some point that a cycles analysis is as much an art, if not more so, than a science. And it's a really interesting thing for him to have said, because it indicates the shift from when he wrote his Profit Magic book to when he took the approach in the cycles course. Because in that cycles course, he is presenting the analysis as a pattern recognition process. It's a learned skill. It's a bit like learning a musical instrument, in my opinion. You have to put a lot of time into understanding it and doing it. The results are that you can become a better analyst, not because of the mathematics, but because of the art that you're applying to it. Before we take a look at the analysis, I'd like to quickly chat about the notation that Hurst used, because this is how he marked his charts, so that at the end of the analysis process, he could understand what was going on, and it can be a little confusing when you first encounter it. So let me quickly explain what's happening here. First of all, when a trough has been identified in the market, it is marked with a diamond at the foot of the chart. A solid diamond means that we are confident that that is a trough of that cycle. You'll notice that the diamonds at the foot of the chart are stacked up into a neat pile on top of one another. That is, of course, because the troughs are synchronized. So when the 40-week trough, which is this pale green color over here, when the 40-week cycle experiences a trough, all of the shorter cycles, of course, also experience a trough because their troughs are synchronized. Then in terms of marking when the next trough is expected, we do that by means of these circles, okay? So we plot a circle when the next trough of a particular cycle is expected. And again, because the troughs are synchronized, these circles tend to stack up on top of one another and develop what Hurst called a nest of lows. That nest of lows is like a triangle standing on its head, and it tells us the expected most probable time for a next trough of that particular cycle to form in the market. And at the far right-hand side, you can see we have some wavelengths here. These are in fact the current wavelengths, and they're counted by counting only the most recent 6 cycles or 180 bars. I use 180 bars because Hurst did on his charts that he published in his cycles course. So you can see that in this particular example, this is not IBM. It's just an old chart I pulled up to demonstrate the notation. But you can see the 18-month cycle has recently been running at 18.3 months. The 40-day cycle down here has recently been running at 32 days, and so forth. So that is his notation. So let's try and make some sense out of all of this and take a look at IBM. So what I'm going to do now is pull up IBM and show you. Here we go. This is an analysis of IBM. And you can see at the foot of the chart that the cycle troughs have been marked with diamonds. I should have mentioned that Hurst never used these semicircles, but I find the semicircles very useful to identify, to visualize the cycles, if you like, because they show you the way in which each one of these cycles is, causing price to bounce up and then drop down again. And so according to this analysis, we have an 18-year cycle trough over here in 1993, another 18-year cycle trough over here in 2008, and then we had a 9-year cycle trough over here in 2016, beginning of 2016. The most recent trough that we've experienced, which was in March of this year, is this little trough over here, which is a 54-month cycle trough. So that is the results of having performed a pattern recognition style analysis on the basis of the initial spectral analysis that was performed by the software. Now, understanding what this analysis means can be really quite difficult. So I've spent years looking at these charts with diamonds at the foot of the chart, and I'm quite used to understanding what the analysis means. But I realized that I spent quite a lot of time speaking to people about it, and they had absolutely no idea what this actually means. So I developed a tool called the Concept Model Line, which helps us to visualize what the analysis actually means. So first of all, looking at this chart, what we would do is we would look at the next big event, which is this nest of lows over here. So this is the next 18-year cycle low, which you can see is expected at about the end of 2023, maybe early 2024. So that's the first thing that we can gather looking at this chart. But it's a little difficult looking at all these diamonds at the foot of the chart and asking ourselves, so what does this actually mean? We know that it needs to go down there somehow, but how is it going to get there? And how do all the cycles combine to get it down to that cycle trough? So the concept model line is this over here, and let me just remove some of these cycles. The concept model line is actually a fairly simple line. What it does, and let me zoom in and show it like that, and clear these semicircles. The semicircles get a bit confusing over there. Okay, so the concept model line, and let me make sure I've excluded the peaks. There we go. The concept model line takes the information found in the analysis and calculated by the software, which is really not that difficult to do because, of course, we are able to calculate the wavelength between each one of these troughs. There's an 18-month trough and there's another 18-month trough. So we can very simply measure that wavelength. And we can also calculate the amplitude of that cycle using an approach that we don't have time to discuss here, but you extract shorter cycles, and what you're left with is clearly the amplitude of the cycle in question. And so what we're doing here is we're taking the results of this analysis and we are recomposing the price action using only the information from the cycles. So we're taking the wavelengths and we're taking the amplitudes and we're putting all that information back together again. And we're saying if the only thing influencing this market are these cycles, and of course I can choose which cycles I want to include. So if I include the shorter cycles, you can see I get a closer price, a closer match to price. So if the only thing influencing price action were the cycles that we have in our analysis, which we have now been able to measure exactly in terms of each one of their wavelengths and amplitudes, then that orange line would be what happened to price. Okay, that's what a composite model line is in terms of what's happening in the past. It is simply recomposing that information. The composite model line then takes it a step further and it extends that information into the future, which I should point out is a deeply flawed concept. Because of that principle of variation that I mentioned earlier, Hurst specified or stated that cycle wavelengths and amplitudes are constantly varying. So if there's one thing we know, it is that cycles are not going to continue to beat with exactly the same wavelength and exactly the same amplitude. However, the composite model line needs some information to present to us. And so what it does is it makes a flawed assumption, which is that the cycles are going to keep beating at the same wavelengths and with the same amplitudes. So with the understanding that it's a flawed concept, the composite model line nevertheless gives us an idea of what the implications of this analysis are. Instead of needing to look at the foot of the chart and see these nests of lows over here, there's that 18-year one over here, we can look at this path and say, well, until the cycles change, which of course they will do, but until they change, this is the expected path that we're going to see the price taking as a result of the cycle analysis that has been performed. So that is the analysis, and that is how we gather from the analysis what we're expecting to happen. I'd like to bring this discussion to a close by speaking a little bit about making trading decisions on the basis of the Hurst cycles analysis that we have performed. So I'm zooming in here, and we're going to take a much closer look at what's happening at the moment to the price of IBM. So as I mentioned, here is a 54-month cycle trough on the 23rd of March, I think it was. Here is an 80-day cycle trough that formed in about the middle of May. We have a 40-day cycle trough over here in the second week of June, and our next expected event, if you like, is that price should be heading down into this 20-week cycle trough. So what should we be doing with IBM at the moment? Well, we are looking for price to drop into this 20-week cycle trough. So how could we trade that expectation or that understanding? Well, one way of doing it would be to display our composite model line, and we'll add some of our shorter cycles and have a look at what those shorter cycles are saying we're expecting to happen. The interesting thing is that the composite model line is actually saying that IBM has already dropped far enough. Here is the low point for that 20-week cycle, and you can see that price has already dropped fairly far down towards that 20-week cycle. And so if we'd been looking at this a few weeks ago, we would have identified the opportunity for the move down into that cycle. But the composite model line is saying that according to the cycle analysis we have on our chart, there isn't really much further for price to move down in order to achieve that 20-week cycle. I should have pointed out, and I forgot to mention when discussing the chart notation, these lines to the side of the circles. So here is the circle for the 20-week cycle, which is expected on the 13th of July. And here is the circle for the 80-day cycle, which is expected on about the 4th or 5th of July, I think. And these lines to each side represent the reasonable period of time before and after the circle, or the most likely time that the trough could form. So in fact, you can see that the 20-week cycle whisker, we call them whiskers, has already been passed. So it is not impossible that that 20-week cycle trough is going to form now. There is another really interesting way of tracking potential trading decisions using a Hurst cycles analysis, and that is using a cycle tool that Hurst defined. Now, Hurst defined two cycle tools. One was called the valid trend line, and the other was called the future line of demarcation. And the future line of demarcation is a really very, very useful tool. It was interesting to watch Peter Eliadis' presentation on Tuesday, because he presented a version of the future line of demarcation, which Hurst presented in Profit Magic of Stock Transaction Timing book, which he called a half-span moving average. Here is the future line of demarcation for the 40-day cycle. And again, we have an FLD for each and every cycle. I call it an FLD, it's the acronym for future line of demarcation. It gets a bit much repeating that every time. So it's a very simple line. It is a very similar line to the line that Peter displayed. In fact, all it is the median price, mid price between the high and the low price, displaced into the future, so to the right. You can see here in the future, we have this line displayed on our chart. We've displaced the median price into the future by half of the wavelength upon which the FLD is based, plus 1 bar. I'm not quite sure why the 1 bar, but you can see the recent wavelength of the 40-day cycle that we're looking at here was 27.3 days. So you would displace the FLD by half of that, 13.65, and you would round that up to 14, you'd add 1 bar. So this is simply the median price displaced to the right by 15 bars. And price follows a very reliable series of interactions with each and every one of the FLDs. So I'm going to run through these interactions. There are 8 of them. So we start with a cycle trough that is at least 3 degrees longer than the cycle that the FLD is based upon. The FLD is based upon the 40-day cycle. Let me write that there, 40-day. So following a trough of at least 3 degrees longer, which is in this case 40 weeks. So if we have a trough of at least 40 weeks, we can start identifying our sequence of interactions. The first interaction we have labeled an A category interaction. And I should point out at this stage, I'm not speaking about what Hurst worked with. He defined the future line of demarcation. This way of analyzing and trading the interactions between price and the future line of demarcation is something I made up. This is not original Hurst material. I feel I should point that out. We're extending beyond what Hurst originally spoke about. So the first interaction, price crosses this FLD. As you can see, it did very clearly over here. At that point, you generate a target. I'm not actually going to get the prices, but I just use these grid lines. So it moved up 1, 2, 3.5 grid lines, and you expect it to extend beyond half, 1, 2, 3. You expect it to extend beyond by exactly the amount, exactly the distance that preceded that interaction. You'll notice parallels here with the demonstration that Peter provided on Tuesday. He's doing exactly the same thing with price crossing a median line displaced into the future. The next interaction, however, price usually fails to cross below the FLD. You can see price comes down to the FLD where it finds support. And it always does that at around about the time that the first trough, following the big trough where we started our sequence, the first trough forms in the market. So the first trough of the 40-day cycle is this trough over here. And at about that time, we expect price to find support at the level of the FLD, which is exactly what it did. And remember that, of course, this line is plotted into the future, as you can see at the right-hand side there. So it's not as if though this line was plotted after price did that. And we label that a B category interaction. The C category interaction, price bounces up and away from the FLD. Very difficult to work out a target. It is possible, but I'm not going to discuss it here. The next interaction is where price crosses down below that FLD. We label that a D category interaction. And again, we calculate a target by measuring the distance. That's 1.5 grid lines approximately. 1.5 grid lines down takes us down to here. And that was our target for price crossing that FLD. And that target is achieved at the time that the next longer cycle forms a trough in the market, in this case, the 80-day cycle. Our next interaction, and you're probably getting the hang of this now, is the E category interaction. And again, we measure a target that's probably about two grid lines. So we go up 2 grid lines, and here price achieved that target over there. That's the E category interaction. The next interaction that we get is over here. That's an F category interaction. Again, we calculate a target, which is again 2 grid lines. That target has not quite been achieved. So there we've had the first 6 of our interactions. We have 2 interactions left before price forms this 20-week cycle trough. Those 2 interactions are where price comes back to the FLD and finds resistance at the level of the FLD. Can you see it doing it over there? That we label a G category interaction. Then price drops away, having found resistance, approximate resistance. It's not exact, but often price will have a high above the FLD and a low below it, and it just can't get past it. Then we have price moving down in an H category interaction. That's our final interaction, which will take us down into the 20-week cycle trough. You have to be a little careful because this sequence can sometimes have a double GH category interaction. So we've got to be careful. That's a G and that's an H. It is possible that price will come back to this FLD, form a G, and then form an H interaction again for the final move down into the 20-week cycle trough. That's how I use the future line of demarcation. I find it a very, very powerful tool. It's a very useful way of taking your Hurst cycles analysis, which started all the way back with identifying the cycles active in the market, then performing pattern recognition analysis, and finally trading it on the basis of the way in which price tends to react with that FLD line. And with that, it's time really for me to say thank you very much. And I do hope you found it interesting.
Fascinating. You're a wonderful teacher. Very clear.
Thank you.
I love your illustrations, and you know, clearly you're a visual artist as well. So
it's the visuals that appeal. Yes.
Yeah. So I mean, this whole world of Hurst cycles has been a new world for me with Peter and now with you.
Right.
It seems to be quite a complete theory of cycles. You know, much different than I had, you know, fully encountered before. It almost seems sort of Elliott wave-esque.
Yes, yes, it's very interesting because Elliott wave is a little bit of it's a closed unit in a way. It covers all aspects of the market, and Hurst cycles do as well.
Mm-hmm.
Hurst cycles are really very interesting because the Profit Magic book is still available. You can buy it today on Amazon, and it's very popular. And most people read that book and they get, very interested in Hurst cycles. But then when they're faced with the cycles course, which sadly is out of print, it was printed by Traders Press, and a few years ago they, I think they declared bankruptcy. So the cycles course is not still being printed, and it's such a pity because there's such a wealth of information in that course. That really completes his full approach.
Can you show an analysis, like a current analysis on S&P 500 or QQQ? Is that too much to ask?
Yes, I can. I'm not sure that I have
We
it.
didn't use IBM, right? That was Ray's choice. So,
Well, yes, because Ray was speaking about the IBM cycles. I thought I would complete the picture.
It's fascinating that it worked as well as it did.
Well, yes, you know what is very interesting about all of this is that Hurst discovered those cycles 50 years ago. And when I started trying to build the software for myself, because I discovered the cycles course and I started doing analysis by hand, and I found it was an approach that really worked for me.
Mm-hmm.
So I looked around for software, I couldn't find any. So I thought naively I would create some for myself. And I set about doing that. And the first thing I wanted to do was to find out which cycles were still active, because I thought surely after 50 years, the cycles active in the financial markets have changed. Mm-hmm. And I did quite a lot of spectral analysis. I used spectral analysis tools to, similar to what Ray was showing us earlier, to identify cycles that have been active recently. And the extraordinary thing was that they were the same cycles after all this time. Wow. This is an old workspace with the S&P 500, and I regret I haven't updated the data, but we can see. I think I've got a few different charts, but I'll just let it run, and perhaps it might show us something. One of the issues with the pattern recognition approach to performing an analysis is it is very time consuming.
Mm-hmm. How long would you say it takes for somebody to become competent at this type of analysis?
That is such a good question, because it's something that I've found myself focusing on tremendously recently. Well, over the past several years, I created the software, and then I thought, well, I'm going to make the software available. Often when people say, "Oh, we want to buy the software," I say, "Well, actually, first I would encourage you to do a course in understanding how the cycles work." And I'm putting a lot of effort into educating people to perform the analysis manually, because it's no good having software do an analysis for you, this kind of analysis, if you look at the analysis and you've got no idea whether it's good or bad or whether it works. So how long does it take? It takes, I would have to say, several months, really of spending a bit of time really trying to understand it. Yeah. I'm still learning. I've been doing this for I started over 20 years ago. I'm still learning new things, but yeah, it is, unfortunately, it's just a very intensive process, understanding how that analysis works and how to do it.
Well, we'd love to have you back sometime and maybe get a more in-depth analysis of the S&P 500 or QQQ.
I'd absolutely love to.
We are getting close to our hour for now,
absolutely.
And I think both you and Ray have done a wonderful job of introducing us to a new world with both math and art. So
yes,
I love it.
Thank
Ray,
you.
are you still there?
Yeah. Thanks, David, and thanks, Richard.
Yes, thank you both. Really appreciate it. And Ray, let's see, I could probably get you to. I'm prompting you to turn on your camera again. There you go. Yeah, that was wonderful, and very excited about having the foundation and the Cycles Research Institute be true collaborators going forward, because we have so much so much work to do, and frankly, not enough people to do it. So
yeah.
Well, thank you for everything you're doing with the foundation. It's really exciting to see the foundation.
Yeah, it's wonderful to see, Richard.
Exciting for me too. So I love it. All right. Well, thank you both very much. We're going to move to the last and final presentation. Thank you, gentlemen. And going to be joined here by Andy Pancioli.
Surely after 50 years, the cycle's active.
Let's see. We got So Andy, there you are.
Hello.
Welcome.
Hi, Richard. Hi, everybody.
Hi. So everybody, Andy is a fellow member of the board of directors of the Foundation for the Study of Cycles. And since I'm going to be presenting next, Andy's going to do the introduction. But before you get into it, Andy, I just want everybody to know that you were quite instrumental in helping to open the door to rescue the foundation at the time of David's passing. You're the one who reached out to me and let me know that that David had passed away, and really opened door after door to help make this possible. So thank you for that. You've been tremendously helpful, both in terms of these I'd call it the mysterious forces that trigger events, right?
Right.
The serendipities that have made so much of what's unfolding this week possible. And then, working every day on behalf of the foundation behind the scenes and doing fantastic cycles analysis yourself, which I hope we'll be spending a lot more time with the foundation audience sharing your work in the future. So thank you for that. And if you would do the honors.
Yeah. So, Richard, well, thank you. If I can just say, I hope you're all enjoying the summit. It really is like a real festival of the very best minds, and that's Richard who's put that together. I know Richard's going to mention this at the end, but Bill Sarubi mentioned we're going to revitalize the Cycles magazine. And Bill Sarubi, Richard Mogi, and myself will be working on that. So please, if you've got some work that we could consider, send it in. I'll be writing to you anyway. So as we continue to enjoy this Woodstock Festival of Cycles megastars, the guest I want to introduce to you now has studied mathematics at the University of California, Berkeley no less. He earned his PhD in system sciences from the Watson School of Engineering at State University of New York, Binghamton, and he studied under the late Professor George Clear. Now, over the last decade, he has researched and developed algorithms and services that provide investors with the tools to systematically develop investing approaches. That's very important. This is what this person does, a systematic approach to investing. And that is also taking place with the foundation, a systematic approach to developing this. He has led and exited multiple businesses based on his work, and his platforms have been used by tens of thousands of individual investors, managing literally tens of billions. He's been involved with the foundation for over 10 years and has helped and in fact been responsible for developing previous iterations of the software. So this man really walks the talk. He is a close personal friend and a trusted colleague. As mentioned, we only met 3 years ago, and in that first conversation, we had a vision to revitalize the foundation. We are now in the process of making this happen, and it's all down to the drive, the commitment, the personal funding, and very much the vision of Dr. Richard Smith. So let me introduce that very mean guitar playing Dr. Richard Smith to you. Thank you, Richard.
Wow, that was fantastic. Thank you, Andy. All right, I will share my screen. Here we go. Give me just a moment, and should have PowerPoint coming up here. Not yet. Where are you? There we go. Is that working, Andy? I'll take that as a yes. So welcome, everybody. We are in the home stretch, and I'm going to spend the next hour approximately painting a vision for the Foundation for the Study of Cycles, and doing that in part through a retrospective of what we have enjoyed this week. Not so much to really get specific trading ideas, but to really see the patterns within the patterns, the wheels within the wheels, which I think is partly what this new logo here of the Foundation for the Study of Cycles describes. So, of course, this is the Financial Cycle Summit. I am Dr. Richard Smith. I'm the chairman and CEO of the foundation. And this talk is about putting the pieces together, the FSC yesterday and today. we have a mission at the Foundation for the Study of Cycles. It is to discover and record cyclical phenomenon in all the arts and sciences, and to promote the application of valid cycles to the progress of humankind. That is what we have worked on together as a board to bring to you as our mission. And I'm just going to mute. So this is very important. It informs everything we do. And you'll be hearing much more about this mission in the weeks, months, and years ahead. So just putting this disclaimer on here. Not that I'm going to be doing a whole lot of forecasting, but seems to be what needs to be done. So let's talk about the founder of the foundation, Edward Dewey. And Dewey wrote, "Cycles, the mysterious forces that trigger events." And cycles still remain a mystery. We've seen a lot of evidence of cycles this week. There's not yet truly a science of cycles. We've seen a lot of glimpses of that. Some of the Hurst work seems to be very substantially in that direction, but this is still an unfolding event. This is still an unfolding quest. This is a new science, a new predictive science that's based on cycles and acknowledges that there are still problems and mysteries that we don't understand. And mystery gets short shrift these days because of such a push of quantification and measurement and evidence and science, right? It's become the new political power. But mystery remains. There are so many things we don't understand. And part of why I love cycles is because they help point out that there are things that we don't understand. And I would remind everybody that no less a scientist than Albert Einstein said, "The most beautiful thing we can experience is the mysterious." It is the source of all true art and science. So folks, let us embrace the mysterious. Let us acknowledge cycles as the mysterious forces that trigger events, and let's seek to understand, because it's in that mystery that we find the things that are really worth looking into and understanding. And that's what humankind has done for millennia. And that's what the Foundation for the Study of Cycles will continue to do. So I am Dr. Richard Smith. I'm really in a new phase of my work in life at this point. You can follow along at richardmsmith.com. And I could not be more excited about all the opportunities and things I'm pursuing right now. Andy mentioned I got my PhD in a field called systems science, which is really a little corner of academia that still believes that there are wholes, W-H-O-L-E-S, and not just parts. Science, so today, is infatuated with drilling down further and further to the parts, but yet when you get to the bottom, which you never get to, the parts don't add back up to the wholes. It doesn't work. Life isn't just about parts. Life is also about wholes. Our human experience is about wholes, and cycles are connected to wholes. That's partly why they can't be reduced to a strictly quantitative predictive system. So I did my PhD work on the mathematics of uncertainty, helping scientists and researchers be more honest about the uncertainty in their own models. And then I got involved in the financial markets, and I help investors leverage uncertainty and understand uncertainty and not be victimized by it. And I earned the affectionate moniker of the Doctor of Uncertainty. I've been a fintech entrepreneur in part thanks to Jake Bernstein, who I met back in late 90s, 2000, when I first started investing. 1999, the stock market's booming. I put my life savings in. I triple my account in 12 months, and I give it all back in about 45 days. Shortly thereafter, when I realized I didn't know what I was doing, I started to work with Jake, and I ported seasonaltrader.com to the internet in 2001. And then I founded a service called tradestops.com in 2005, which grew to 30,000 subscribers, tracking $20 billion of assets on that platform. And I help people build portfolios and manage risk, especially using volatility, much like what Perry Kaufman shared with us, but in a very user-friendly way. I recently exited that business, and it carries on in good hands. And today I'm building new financial technology, which I'm planning to launch later this year. Very excited about it. And of course, I'm the chairman and CEO of the Foundation for the Study of Cycles. I've been helping the foundation. I've given a lot to the foundation for over a decade now, which is what enabled me to help pull it out of the ditch that it ended up in a couple years ago. And I've developed my own proprietary cycles technology, which I'll also be sharing more in the coming weeks and months. I appreciated what Jake did, letting everybody know where he was. So I am in Southwest Virginia, kind of south of Roanoke, about here, close to Virginia Tech University, in the Blue Ridge Mountains, with the deer and bear and wonderful wildlife and nature surrounding me and my family. So just a little bit more about why I'm here, why I'm doing this with the foundation. You've already gotten inklings of this, but I believe that we're missing some major components of the human experience in our world today, and we're desperately in need of a course correction. And yes, cycles can help us forecast financial markets, but cycles can help us in our lives. Cycles can help us in our economy. Cycles can help us in all areas of life. And we have really kind of ignored the cycles, and we've really disrupted a lot of life by not honoring the cycles of life. And so the Foundation for the Study of Cycles is part of that, I would say, reawakening of the mystery of cycles. I believe cycles can help us in many areas of our lives, which I've already said. I love the foundation and I love discovery. And I believe in individual freedom. I believe that people should have knowledge that will help them be free, financially free, and emotionally free, free of illness. We'll talk about Dewey's mission for the foundation later on. And this is an embodiment of that. And I believe in a universal creative intelligence. You can call it whatever you want. You can call it God. But I believe there are patterns that inform our world that we can seek to understand, and that those patterns are the result of a universal creative intelligence. And I believe that all of you share this vision as well. And that is a unique part of the Foundation for the Study of Cycles, where we can be both art and science, spirit and science, a very important part of the history of the Foundation and its future as well. Of course, I'm also here because of my professional background. I build technology, cycles technology, seasonal technology, portfolio and risk management technology, and together with my colleagues at the Foundation, especially Lars von Thienen, we are continuing to build technology, and we want the Foundation to be a technology infused enterprise, and to take advantage of the technology that Dewey never had access to, but that we do today. That we will be building technology. I'm a mathematician and system scientist. I love this stuff. I'm a successful entrepreneur who's fortunate enough to be able to give back via the Foundation, as so many of the speakers who have shared their time and board members who are sharing their time and resources with us. I'm good at building teams, and I am your advocate. I hope you've seen that through these presentations, that I want to understand things. I want our audience to understand things, and I will fight for you. But I can't do this without you. We need to do this together. And I'm inviting you to join us on this journey. All right, so just real quick, here's what the foundation looked like when Andy and Nathaniel and I pulled it out of the ditch. And here's what it looks like today. So this is the order that's being restored, the quality of people that are involved who care about it, want it to be preserved and succeed. And this is the work that we're doing and the work that I hope you'll support. We've recovered and restored the archives, which you just saw pictures of. We've got a new charter with a clean slate. We are once again a 501c3 IRS tax exempt organization. So you make donations, they are tax deductible. And that's very important for the integrity of the organization, that we have that status and that we preserve that status, and we will. We've got a new board of directors. I'll highlight some of that for you in just a minute. We've rebuilt and acquired the domain cycles.org, which is where the home of the foundation should be and now is. We've deployed an online cycles analyzer. Thank you, Lars. Cycles library. We want to be digitizing the archives more and making that available online more and more. We've hosted this Financial Cycles Summit Week. And our board of directors is Jake Bernstein, Ian Mackay, Andy Pancioli, Richard Smith, me, of course, Bill Sarubi, and Lars von Thienen. And let's see, I better just stay on the PowerPoint rather than jump around. So, and our COO is Nathaniel Hansen. Nathaniel was very instrumental in pulling the foundation out of the ditch, helping to secure those assets, and has been a tireless worker and supporter of the foundation for many years, and especially of late. Yeah, so thank you, Nathaniel. All right, so excuse me while I just get a drink of water. Let's review what we've seen this week. Let's see if we can put the pieces together. First of all, I want to acknowledge and thank all of our speakers. This has been an incredible lineup. They all have their own businesses. So I hope you'll take the time, if you're interested in any of their work, to look into their businesses. I think I might have made a mistake on Ray's site. It's cyclesresearchinstitute.org, but this is here. This will be available in the recording. So please come back here and visit the businesses of these very successful cycles analysts and market mavens, really. So thanks again to all our speakers. So Sherman McClellan kicked us off, shared with us that cycles can be spooky accurate, and I'll show an example of that. These are just highlights from each speaker's talk. That the S&P 500 is likely to probably be flat to struggling through the summer, probably rise into the fall, correct after the election, top in February, March 2021. After that, all bets are off. The Fed intervention, QE4, is disrupting the cycles. The Fed's not likely to back off before the election for the risk of being seen as interfering in the electoral process, as if they aren't already. But politics is what it is today. Sherman uses buy and sell win percents to select cycles, which is interesting. And like I said, the Fed likely to support the market into the election, so they won't seem political. A few of the highlights from Sherman's presentation. This was a forecast that was made back in June of 2018 that forecasted bottoms in January 14th, 2019 and March 28th, 2020. So this is the kind of forecast that can make you get goosebumps about what cycles are capable of, although not necessarily that tradable, but still quite striking that you can make these forecasts. Sherman had this, on his bookcase for years, followed it. And the bottom in January was within 6 trading days. And then the bottom in March of 2020 was within 3 trading days of a bottom that had been forecasted back in almost 2 years earlier. So you do see these kinds of remarkable, spooky forecasts and cycles sometimes. I've not really made money off them, but they are majestic and they speak to a mystery that we don't fully understand yet. This is Sherman's forecast made back in in June of 2019, again, about a year before. Again, forecasting a bottom in March, a top fairly soon in June, top in October, and then same forecast updated with more recent data through March 31st of 31st of 2020, topping around July, November, and again in March, bottoming in December. So great examples of, I pay attention to this forecast. I'm keeping my eye on it. I want to know how it unfolds and how it shifts over time. And that's what cycles can do for us. Sherman also shared with us a striking correlation between crude oil and the Dow Jones. When you lag the Dow Jones by 10 years, somehow crude oil 10 years ago is highly predictive of what the Dow Jones is going to do today. Must be cycles in the economy. And this particular correlation suggests that we could also see a high in the Dow in around March of 2021. So Sherman also shared with us some of his advanced decline and up-down volume work, which is absolutely essential, so complementary to cycles. This is all available through his website, MC Oscillator, with Tom and Sherman McClellan, who do phenomenal work. And I've found this volume and advanced decline market breadth work to be very useful and very complementary to cycles. Then we heard from Larry Williams, another 50+ year market veteran. Only cycles that matter are the ones that fit your time frame. Don't get distracted. This stuff isn't for everybody. Be careful. Really appreciated Larry's honesty and candor about, he said, I've written a lot of books. They've helped a lot of people, but they've probably ruined a lot of lives too. And these markets can be quite perilous. So I often say people treat investing, if you were thinking of learning to fly a plane, you wouldn't just walk out to the runway, hop into the cockpit, and start heading down the runway. You would be sure to die. But that's the way people treat investing. It's presented as, and speculation, as something that you can jump in and do. And it's just not true. So take your time, learn from these masters, learn from the foundation. It's wonderful, lifelong endeavor. There's no rush. Be careful. Cycles are setups. Events drive the magnitude of the cycle. God doesn't want us to know the future, but he does give us a glimpse. There are solar cycles, sunspot cycles, geomagnetic storms. That was very interesting. We'll be looking into that some more. I know some of our board members have looked into that as well. Looking forward to digging into that. We saw a 65-week cycle in the Dow Jones and spent a lot of time on 1-year and 4-year cycles, which recurred throughout many of the speakers. So we'll be coming back to that. Here's Larry's 65-week cycle, something to keep an eye on. Topping probably in around March of 2021, right about in line with Sherman's forecast. Larry's forecast for the year. Okay, here we are, April and May, right? We had a panic indicator that Larry talked about that probably thwarted this down move or made it come a little earlier. And we also heard from Larry about election year cycles. And that's the average cycle in blue here of the election years, something we heard from multiple speakers. Is there a cycle to market panics? Doesn't seem so. Larry can't find it in the data. But when you do see a panic, you better pay attention to it. And we definitely got a panic indicator in March. And Larry pounded the table that this was a major buying opportunity, which it has turned out to be. So panics might not be cycles, but again, pretty much no one that we talked to this week said, I just use cycles and trade the cycles, right? Everybody said they support it with sentiment, with different indicators, and that cycles are setups. You need something else to be the trigger. We also heard from Jeffrey Hirsch of StockTradersAlmanac.com, son of Yale Hirsch. There's literally 2 generations of work there in the Hirsch family. Yale Hirsch was very influential in the early cycles work, along with Hearst, Dewey, and others, and influenced a whole generation of cycles people, including his own son, Jeff, who now runs the Stock Traders Almanac. Wonderful, inexpensive resource available to anyone. But again, use history as a guide, not gospel. Don't become so enamored of the cycles that you, start to place your bets just based on the cycles. They're guides, not gospel. That was a quote from Sam Stovall. Hope to have him on the Foundation TV here sometime soon. We heard about the presidential cycle, saw lots of evidence that it's real. The post-election year syndrome, which I'm going to be reviewing. The best and worst months strategies. This was absolutely unbelievable. I'm prone to say there are no silver bullets, but this one may be a silver bullet. Maybe the only thing you need to know if all you really want to do is make money and not do a lot of work. So definitely something to pay attention to. Recession lows are likely in based on unemployment numbers. Jeff teased us about some intraday timing strategies too that still persist in the markets in spite of all the high frequency trading and other things going on. Markets tend to lull around 2:30, rally into the close. He didn't give us details, but a lot of credibility there in the Hirsch family, and they're seeing the patterns in the intraday world, and I'm sure they're there. This is the 4-year election cycle that Jeff shared with us. Biggest gains in the year before the election, lower gains in the year of the election that we're in right now, right? And it's true in both the Dow and the NASDAQ. So, post-election year syndrome. We got one coming up, 2021. A number of people have told us that 2021 looks uncertain, and that could be aggravated by this post-election year syndrome. Another thing to pay attention to. We saw a lot of seasonal patterns. Here's the Dow Industrial Average. The green line here is the, not sure why my cursor froze there, but the green line is kind of the average performance of the Dow. Here we are in June, little dip right now, seeing this right now, with a rally into July. You want to know how to make money? There's a dip in June, late June, and a rally into July. What did we see in the markets today? We saw a dip. I don't think that dip is likely to continue, even though it was a dramatic dip, and we're seeing a lot of sentiment influenced by it. But the patterns tell us over and over again that we often have a rise from late June into July. That's been the pattern from 1988 to 2019. And Jake showed us this exact same pattern too. In fact, a buy signal on June 28th. This is unbelievable. Investing in the best 6 months of the Dow or 8 months of the NASDAQ and combining that with a simple MACD indicator makes takes all the money out of the market with a lot less risk. 9.1% annualized gains from 1950 to 2019 would have turned, I think, $10,000 into $3 million. Whereas being invested in the worst market months were down, you got negative returns over that 60-year period. I mean, how much more evidence do you want? We asked Jeff, what MACD indicators do you use? He told us. For buy signals, we use a faster MACD, an 8, 17, and 9. For sell signals, we use a slower MACD of 12, 26, and 9. And these are the original MACDs of Jerry Appel, the creator of MACD. So phenomenal phenomena that we see in the markets year after year after year. We heard from Peter Eliades and got our first glimpse into Hurst cycles. Peter shared with us a beautiful chart showing how cycles and fundamentals interact to create market patterns. Told us as an entertainer, he's seen the lunar cycles firsthand, along with emergency room physicians. Hurst cycles, which we heard a lot about today, fixed nominal cycle lengths. Cycles can help predict move magnitudes. Totally different way of looking at cycles. Don't pay attention to time. Current S&P minimum projection is 3,465 based on the cycles. I'm just replaying this. Peter, I took it from your site. You said I could, but this is a great illustration of cycles in the markets, of different frequencies and wavelengths, all interacting. And then short-term cycles, longer-term cycles, fundamentals, sometimes they're up, sometimes they're down, all combining together. When you add them up, simple vector addition creates these patterns that we see in the markets. And here's the projection from Peter and this, what did you call it, David? A line of demarcation. Similar system, cross the line, double from the length from the bottom to where it crossed up again, gives you this projection into the 3,500 range that is still likely unfolding. We heard from Bill Cerubi of cyclesresearch.com. As simple as a 1, 4, and 10-year composite cycle. Offensively simple, which I'm going to come back to later on. Bill, you're actually results. The 1, 4, and 10-year cycles deliver results. I don't care what your theories are about the economy or how smart you are, how many degrees you have after your name. I want results. I'm not impressed. God bless you, Bill. Don't be stupid by pretending that you're smart. We saw an 18.6-year cycle in real estate, also from Jake Bernstein. Bill mentioned the work of Phil Anderson, something I'm looking into now, propertysharemarketeconomics.com, if you want to look into it yourself. Looks very compelling. Likely coming up on another top in the real estate cycle over the next, 1, 2, maybe 3 years. Talked about war cycles and panics. And he highlighted the 10-year cycle, which was, we really only heard from Bill, but years ending in 0 have had the worst returns. We're in a year ending in 0 right now. Years ending in 2 have a tendency to bring market lows. Years ending in a 5 have had the best returns. 7s have brought crises except for 2017, and 8 and 9 usually don't terminate bull markets. Where are we right now? 2020 with 2022 still ahead. I would not be surprised. A beautiful illustration of how simple it really can be. Taking the 1-year average cycle, the 4-year average cycle, and the 10-year average cycle, combining them through simple addition to get a forecast. This was 2016, and this blue line is the forecast for 2020. Here we are in May, June. Some down trend forecasted by this cycles model. Again, it's just a model, but it's one that's quite compelling, simple, easy to follow. Doesn't mean this is going to be exactly how it unfolds, but something you want to be aware of. There's some conflict in that model with Bill's monthly model, which shows here we are right now, late June, strong movement up throughout most of the rest of the year. This happens in cycles. You get conflicts. You have to have triggers, not just cycles. Cycles can tell you anything you want them to tell you. We hone in through the Foundation for the Study of Cycles on the best methodologies of cycles, but even the best methodologies still have ambiguities. You can still see whatever you want to see. So it is an imperfect science. It will likely always be an imperfect science. As Larry said, God doesn't want us to know the future, but he does offer glimpses. And you have to be able to work with different forecasts, but back them up with triggers. Bill is continuing to follow the work of Wheeler and his war cycles, seeing a cycle peak in 2021-22, right about the time that you usually see a bottom in the 10-year cycle. Phenomenal panic cycle index based on 400 years of data in September of 2020, producing a forecasted top. Seems probable to me. And so simple, based on ones and twos, one for a non-panic month, two for a panic month. Go back 400 years, 500 years, run the cycles on it, and somehow forecast a panic top in September of 2020. Amazing. And then I loved this quote that Bill shared with us. Why do cycles work? You want to know why it works? I don't know why it works. When you get to the pearly gates, you can ask the grand high muckety muck, and he probably don't know either. That was John Nelson, the famous RCA engineer who discovered that planets' positions can influence radio signals, and summed it up in a Mark Twain way. We heard from Perry Kaufman, a rocket scientist, literally, who worked on the Gemini missions back in the mid-60s on navigation systems. He talked to us about seasonality in presidential cycles. Again, recurring themes. Seasonality, what is it? It's a one-year cycle. He shared with us a mean reversion strategy in the grains. Grains have kind of a permanent bearish bent these days because crop yields have gotten so good. Farmers have gotten so good. And so when you see grains get away to the upside early on in the cycle, they're probably going to come back to earth. I asked Perry to share his work on controlling portfolio volatility. It's not cycles work, but that's similar to what my work has been based on, volatility budgeting. And it's super important. And I know it's complicated, but it's worth your time. And I hope to be describing more of it in the weeks and months to come. He also shared with us some asset selection by ranking. Nice system there. And all of this is recorded on YouTube. You can go back and study all these presentations just like I've done. But what's most striking about Perry's work is that even though he's literally a rocket scientist, he is always cutting away optimization. He's always looking for the simplest approaches, like equal weighting of your positions instead of doing fancy cap weighting or other methodologies. Keep it simple, do what works. That's what's going to give you confidence and make you successful. Here's the current where we are in the presidential cycle pattern of the Trump presidency. Strong first year, weak second year, super strong third year. So far, a bit of trouble. And we'll see how this plays out. Go back and look at Perry's presentation. Get his book. It's in the 6th edition now, Trading Systems and Methods. This is important work. And I hope to be able to help people. This is really very connected to the new financial technology that I'm working on and that I hope to share with Foundation members in months ahead. But this is the kind of results that you can get by simply targeting a certain level of volatility in your portfolio, not having the volatility too low, not too high, the same system, just using volatility stabilization, getting a 1,600% return or a 7,000% return, okay? It's extraordinary. You have to be paying attention to this. It's very important. We heard from Jake Bernstein, a fantastic presentation, absolutely captivated the audience. Nobody left their seats. Google Teach Me Day Trading, get 81 million hits, and it's garbage that you will pay dearly for. I've seen people pay tens of thousands of dollars for information that doesn't help them. You can get it all and more from the foundation for $99 a year. Thanks, Jake. Why do we need economists when cycles predict where interest rates are? And do we have the same conclusion? Again, don't be stupid by thinking that you're too smart. Long-term cycles are very compelling. Likely real estate peak in 2020 to 2021, right about now. Daily cycles in the S&P topping about now, seeing the correction. 19 test questions that you should be able to answer about your system. All of this available in Jake's talk. Setup, trigger, follow through. 50 years worth of experience in that little equation. Seasonality, seasonaltrader.com, the original site that I programmed almost 20 years ago. Some of the cycles Jake shared with us. Short-term interest rates in Europe. Boom, boom, boom. Pretty good there. Little early, but still a bottom over a 30-year period. British pound, again, again, again. Cycles are in the data. It's unmistakable. Japanese yen, again. Combining cycles with other market-generated information sources like commitment of traders, again, it's sentiment. We saw, what is this? Oh, this is the current data on the S&P 500. This is Jake's daily sentiment index here. Sentiment has gotten a little ahead of itself. Not surprised to see that we're having some corrections. And the daily cycles in the S&P 500 are peaking. The daily cycle that Jake found based on the foundation's technology. I'm not sure what cycle this is, but they're peaking right now at a top, along with a top in sentiment, a confirming indicator. Yes, we're gonna see some pullbacks in the markets. And that's what we're getting. Setup, trigger, follow through. We heard from all the speakers. You can't, cycles are setups. They're not used by themselves. And these are all presenters who have literally decades of experience and who have been successful. That's why they're speakers. And every one of them told us cycles are setups. You don't just trade the cycles. You need a setup. You need a trigger. You need follow through. Study Jake's presentation. It's all in there. It's all on YouTube. Take 2 days, go through all the presentations. You will have at least a year's worth of education in 2 days. Here's the pattern we just talked about in the Dow again. This is for 100 years of average prices, starting in the end of June. The first 2 weeks of July, seasonally very strong. I forget which presenter we saw this in. I think it was Jeff Hirsch with the Stock Traders Almanac. Okay, everybody's selling. Today, I don't know where the market ended up, but there was a panic. You know what? I was buying. I'm buying because I know this seasonal pattern. It's statistically significant. It's been tested over 100 years. I know that the media wants to tell us that COVID cases are getting out of control. They make up the stories to explain the cycles, okay? Pay attention to the cycles, ignore the noise, use a trigger, and follow through. Another trade from Seasonal Trader, buy it on June 27th, sell it on July 15th. That's the seasonal pattern. 78% wins over a 100-year period. We heard from Stan Ehrlich, the early cycles inventor of the Ehrlich Cycles Finder, and really a short-term trader with some hard-earned wisdom starting from the futures trading pits in Chicago back in the 60s and 70s. Limit your losses and let your profits run. Lila Leiper. And sell into rallies and buy into dips. Sierra Bid. I really liked how Stan shared with us what he called the cycle woo, the window of opportunity. 5% on either side of the cycle bottom or top. Again, a setup. You need a trigger. Look for that setup within that 5% on either side of the cycle bottom window and look for a trigger. Love it. Still has a very simple approach to cycle finding. Has developed very sophisticated reversal systems, which he shared with us based on RSI and average true range. This is advanced stuff, but Stan shared it all with us. It's available in his presentation, and he's a very experienced teacher and generous with his time. And I know he wants to share a lot of this with foundation members going forward. So we look forward to that. Highlighted some October's lows, seasonal trades, the Santa Claus rally, and a 52-day cycle. Look at this. This is amazing. October lows, an annual pattern, right? It's this simple. Take Stan's Cycles Finder, spread out the accordion, put it on your screen, or use TradeStation. Buy on a trigger after the October lows, sell based on a smart trailing stop using volatility, average true range to get you out of the market. Some extraordinary trades here, all based on cycles combined with some good triggers. The Santa Claus rally, buy a few days before Christmas, sell a few days after the new year, do it in tranches, 1, 2, 3. Okay, buy on 3 days. I think it was 10:55 a.m. Stan told us, I forget. Day 1, 3 days before Christmas, 2 days before Christmas, 1 day before Christmas, 1 day after the new year, 2 days after the New Year's, 3 days after the New Year's. It works. Look at 2018, bought on the bottom, sold at the top. Who doesn't want that trade? So it's all at the bottom here in the woo, as Stan says. This doesn't involve any kind of fancy analysis other than looking at your charts, looking at the patterns. Missed this one. Could have gotten a buy here out with the stop, but caught that on the money. And, we recently had a low in that 52-day cycle too. So further confidence that we're probably not headed to new lows in the first couple of weeks of July. Don't panic. So what are the common threads we've seen? These are all successful analysts with credibility and track records, and they see value in cycles. That was very striking to me. All of these presenters do not have to use cycles. They can use anything they want. And yet, after decades in the markets, they use cycles and they want to understand more about cycles. They support the Foundation for the Study of Cycles for that very reason. That's very compelling. We saw over and over again, cycles can't be used alone. right now. They need additional filters. You need triggers. And then you need follow through. That's where the risk management piece comes in. Cycles are setups. They're a tool. They don't have to be complicated. It can be as simple as looking at the charts and counting the days. We saw that from Larry, from Jake, from Stan. And we saw it today with Ray and David. They can be very simple. We heard about the 4-year cycle and the 1-year cycle. You know, if you do nothing else, just factor these cycles into your existing approach to the markets. A 1-year cycle and the 4-year presidential cycle, it will change your results with very little effort and without a PhD. My read is 2020 is likely going to be okay. We see that in the cycles. We see it in the recovery that we've had in the markets. We see it in the breadth data that Sherman and Tom McClellan track so beautifully. And it was pretty consistent across most of the analysts that shared their work with us this week that 2020 is likely to be okay. 2021, on the other hand, is a little scarier. We see war cycles peaking in 2021. We see the crude oil correlation with the Dow Jones suggesting a top, the cycle, long-term cycles forecast suggesting a top. We see the 10-year cycle that Bill shared with us. Years in 0 are problems and years in 2 are likely bottoms. So 2021 is kind of on my radar as something I'm going to be a little more wary heading into, which is a funny thing to say given what we've seen in 2020 so far. But that's kind of what the cycles are telling us. And we heard from all the speakers that the foundation for the study of cycles matters, and to please support the work of the foundation. We have so much to do. Please become members, make donations, and hopefully some of you of means will want to support the foundation in even more substantive ways and help us to really realize its full potential. So I want to wrap up before really wrapping up with just sharing a couple of cycles from the Foundation Cycles Analyzer that is available to you as members of the Foundation. Thanks to Lars von Thienen. And this is a simple cycle. I think this is the 172-day cycle. Oh, yep, there it is. So this is one of the strongest cycles in the S&P 500. And I forecasted this cycle on the Cycles app, available to the Foundation members, with data ending in December 31st of 2019, okay? So this forecast was made before, with data that ended at the end of 2019. It did not know the future from where you see the price line change from dark blue to light blue. Did a pretty good job telling us that there was going to be a down cycle. Had no idea it was going to be that severe, but nicely captured the cycle. Look at this, captured the bottom in 2019. Nice bottom in May of 2018. Bottom back here. Even did a pretty good job on the tops. So this 172-day cycle, it shifts around sometimes, but it is at work in the markets, especially in the S&P 500. It's something to pay attention to. Suggests a top in mid-August and a bottom in late October. This is the strongest short-term cycle in the markets in the S&P 500, a 26-day cycle. Bottoms on June 27th. That's tomorrow, effectively today. Tops on July 11th. How many times have we seen that? We saw it from Jake. We saw it from Jeff. The Cycles app picks it up using a spectral Fourier analysis with a Bartel's test. Buy on June 27th, sell on July 11th. Same thing we saw in Jake's seasonal trader program. And I had one more slide I was going to do, but I didn't get to it. But it was basically going to be a combination of these two cycles, give you a little more nuance. But we've seen how cycles get added together to create a little more nuance in the forecast. But these are two cycles to pay attention to. The 172-day cycle still up into August, and the 26-day cycle up from now until July 11th. So I'd like to finish with telling you why cycles work. Cycles work because human beings are arrogant and short-sighted. We are arrogant and short-sighted. We refuse to acknowledge that things can be this simple. We want to think that we're smart. We want to pretend that we're the cause. Jake Bernstein has been publishing seasonals and cycles for the world to find out, to discover for 30, 40 years. They keep working. This cycle from going up at the end of July until the end of June until the middle of July is probably going to work because people don't want to believe it's that simple. As Bill Cerubi told us, cycles are offensively simple. The heads of hedge funds don't want to pretend it's that simple. They want you to think they're indispensable. They're the reason it's successful. We refuse to believe that any forces exist in the universe beyond our personal preferences. That's a huge mistake. It's short-sighted. We need to do better. We want to think that we're smart. We're not that smart. So, you want evidence? I've got evidence. This is an absolutely stunning study that was shared with me by a colleague from the UK. We don't know this in the United States, but in the European Union and the UK, brokers on their sites have to publish how many of their clients make money and how many of their clients lose money. I know this is small print, but I'm afraid to tell you, sorry to tell you, that this orange bars over here, this is the percent of people that lose money when they open up brokerage accounts. And the UK and Europe, you have to publish this. This is the best case here. One broker that lets you automate your strategies by tracking other successful people's work. Even following successful strategies, only 35, 36% of the people are successful following other people's successful strategies. 65% fail. The worst case, 14% of the people make money, 86% of the people lose money. Everybody thinks they're in the 15%. Everybody thinks, they're a better driver than everybody else. We can give that up. We need to be humble. The markets will humiliate us if we don't come to the markets with humility. So the average percentage of clients that lose money across all these brokers, 76.3%. Why? Because and this is out of my direct experience. I was studying to get my PhD, finishing up, becoming the doctor of uncertainty, and didn't work. You have to let the market tell you what's happening. You have to follow the cycles coupled with triggers and follow through so that you're not in the 76.3%. So that you're in the 15 to 20% of people who make money. That's why cycles keep working. That's why the foundation for the study of cycles is here, to better understand this, to empower people to understand what's happening in their lives and in the markets, how to be more successful, and how to have more fulfilling lives, which is what we heard from a number of people. Cycles haven't just helped them be successful in the markets, they've helped them be more successful in life. So we're working to bring a knowledge of cycles and continuing study of cycles to everyone. We're republishing Cycles magazine starting in Q4 with Bill Cerubi and Richard Mogi and Andy Pancioli. We're digitizing the FSC archives. We need help with this. This is a great project if somebody wants to sponsor this. We want to have an annual conference when we can get all together in person again. We're continuing to develop a cloud-based cycles tool and a data warehouse with high quality data that we can have cloud-based cycle studies on available to members of the foundation. We want to rediscover cycle synchronies that so inspired Dewey to start the foundation. Develop a mobile application to help people track cycles in their own lives. We need fundraising. We want to build an endowment. We want to commercialize the foundation's technology. So anybody who wants to help, please email me, richard@cycles.org. We will be expanding our communications in the coming months. We've really been building the infrastructure to make all this possible that we were able to deliver this week. We're just getting started. Please subscribe, become members. Many of you have been on a 3-month trial. That ends in June, and we hope you'll become paying members at $99, which is really a donation because we are a not-for-profit. So if you can't afford $99 and you really want to be a member, please ask for an exemption. But $99 for a year of access to support the foundation and be a member is very helpful, and we love donations even on top of that. I think this week we've delivered probably thousands of dollars worth of market knowledge, if not more. And I hope you'll support the foundation. And for those of you who want to get involved in a serious way through time or money, please email me and let's talk. So I will wrap this up with revisiting Dewey's inspiration for the foundation, his 5 cathedrals, the advancement of human knowledge. And we're doing that even here in the Financial Cycle Summit. Ray Tomes and I will work together to have a scientific cycle summit, hopefully in the fall or winter, with the Cycles Research Institute and the foundation. The elimination of war. If we can document the cycles of war, can we be more cautious, less bellicose when we know those cycles are peaking? I think so. But the world has to know that there are cycles of war. We have to do more study of this to help us understand these influences in our world. The elimination of depressions. Dewey started the Foundation for the Study of Cycles because he set out to discover what had caused the depression and the stock market crash by President Herbert Hoover. He was the chief economic strategist in the Hoover administration. He asked 100 economists. They gave him 100 different answers. He discovered cycles. He saw cycles not only in the economy and the markets, but also in the sun and in wildlife populations and vast other areas of our global experience. So still to this day, we hope that the foundation can contribute to flattening the curve, so to speak. And speaking of flattening of the curve, elimination of disease, another true cathedral worth building, and accurate weather forecasting a year or more in advance. These were the 5 cathedrals that Dewey aspired to for the foundation. They are quite lofty, obviously. We are not there yet. But yes, we will study the markets and we will make money, but we should also pursue these aspirations that Dewey had for the foundation, and through our financial prosperity to contribute to a greater prosperity, not just for ourselves and our families, but for everyone. And that is what the Foundation for the Study of Cycles is here to do. So I thank you all. I thank all the speakers again for a tremendous week. And I look forward to working with you all in the months and year to come to build Dewey's 5 cathedrals and to kick some butt in the markets, because we can do it. And it is within our reach if we will come to the markets with some humility, study cycles, be disciplined, bring a little bit of mathematics, but don't pretend that there's not still mystery. Mystery is what makes life worth living. And we need to embrace it, and we need to pursue it, and we need to try to get to the bottom of it to make discoveries. And together we can do that through the foundation. So I thank you all. I will look at the question thread, which I have ignored so far. I don't know, Andy, if you're still there and if you want to come back on, if there's any pressing things that we need to wrap up with here. But
no, just really, I think on behalf of everybody, I'm looking at the comments here and moderating at the same time. Richard, it's just been a fantastic presentation. We've had tremendous speakers all week. We're very grateful to you for making this happen. Certainly on behalf of the rest of the board members, we want to thank you for being the fantastic leader. And we know we've got everybody's support in taking this up to somewhere absolutely phenomenal, to heights that can serve humanity and mankind that have never been seen, before. We're all committed to the cause. So Richard, thank you so much for such a fantastic week, and also a really inspiring close.
Thank you, Andy, and thank you to all the board members who have helped pull this together. We look forward to your support, and we look forward to continuing to share our work and the work of leaders in the world of cycles a lot in the future. This has been very inspiring to us about how much people care about it. So thank you, and good night.